What's happening, guys? Today I want to talk about mortgage points and rate buy downs and how all that stuff works. There's kind of a big misunderstanding, especially from the consumer side, on how mortgage rates and points and costs and fees and all that stuff work. So I want to explain to you exactly how it works, okay? So that way if you're shopping for a mortgage, it doesn't matter what that's for, meaning if it's an investment property or if it's just a regular property that you're buying as a primary residence, you know what you're looking for, okay? So the first thing I want to talk about is par rate, okay? And so this is a common term in the mortgage space, and what that really means is par rate is the rate that a borrower will qualify for their scenario on a particular day, okay? So I want to give you an example. If I go to get car insurance, okay, and I see maybe an ad on the TV and it's like, you know, the general, the guy with the little hats always walking around, Shaq does all the commercials. Let's say I see the general auto commercial or general insurance commercial, and it says like, your insurance is insurance $29 a month, and you're like, that's really cheap insurance for a car. So you call in and you start asking some you call in, they start asking you some questions like, you know, Johnny, yeah, we have insurance for $29 a month. Tell me a little bit about you. And I started telling them, well, I've been, driving for, 10 years, and I do have one accident that I got in last year, and I have a speeding ticket. And so they come back and they say, well, okay, well, $29 a month is for somebody who's been driving for 20 years and has no accidents and has no tickets. But since you have that accident and since you have that ticket, it's going to be, $39 a month. And because the ticket, it's $49 a month. And by the way, Johnny, do you have anybody under 25 in your household? Yeah, I got a couple kids. Okay, fantastic. Well, unfortunately, there's going to be some adjustments taken. So now it goes from 29, 39, 49, 59, and that premium starts getting larger and larger because my situation is different than everybody else's situation. We call those adjustments in the mortgage space. And so when we talk about par rate, what we're talking about is interest rates are always moving, okay? So the market is always moving, and so rates are always moving. So I'll give you an example. The rate of 4% is always in existence. You can always get a 4%. Okay, the question is how much it costs. And so let's just say somebody calls me and they say, Johnny, I want to buy a property, and I want to buy a property. What do rates look like? And I go in and I kind of run the scenario, and the market's moving, right? It's up and down. People are, bonds are being bought and sold, and other things are impacting that. But it's moving, just like the stock market. And I say, okay, what's your credit score? How much money are you going to put down? Is it an investment property? Is it a second home? Is it a primary? Is it a townhome? All these different things, because all of those would create adjustments to that person's scenario. And they say, okay, everything is fantastic. I have an 800 credit score. I'm putting down 40%, which you would never want to do, but let's just say I'm putting down 40%. It's my primary residence. Everything is immaculate in my file. And I say, okay, Mr. Borrower, based on your scenario and where the market is today, the rate that you would qualify would be 4%, which is par rate, which means there is no cost and there is no credit to that. So every rate has an associated cost or credit with it, okay? And so in this scenario, his par rate is 4%. Now he says, Johnny, I don't like 4%. My neighbor Tim, dude, he's got a 3.5%. I can't let this guy beat me. I need to have a 3.5% like my neighbor so I can talk trash. Cool. I tell the borrower I can get you 3.5%, but based on where the market is today, you actually have to pay for that rate. So that might cost, let's just say $5,000. It's a $5,000 cost to get you to that 3.5 rate. Now, the question always is it worth it? Well, it depends. Are you going to be in the property for a long time? How much money is it saving you, per month, and then over that time? So buying points, okay? So buying points and buying the rate down sometimes has its advantages, and sometimes it doesn't. The other side of it is for example, there are closing costs that are always going to be associated with a real estate transaction. So let's just say, just for lack of a better example, in a totally hypothetical scenario, Closing costs are $5,000. Okay, this is title fees, escrow fees, and yada yada yada. It's $5,000. So I go to the borrower, the person who called me, and I say, yeah, your par rate is 4%, but if you take a 4.5%, which is a higher rate, which is going to come with the higher payments, I can actually get you credit. I can get you a $5,000 credit, which can be used to offset those $5,000 closing costs. So you go higher in rate, and you're getting like a gift card. I would say it's like a gift card that's going to offset those closing costs. So this is how rates and points work. The market is always moving. So today's par rates for this particular borrower might be 4%. Tomorrow it might be 4.25%, or it might be 3.875. It's always going to be moving. And this is why a lot of times loan officers will say, well, I'm not locking anything today, so it's kind of subject to change. And they're partially right. And the other side of that is they kind of always want to leave a little bit of wiggle room in case, the market drops or it goes up. They want to make sure that they're not kind of kicking themselves in the rear end and telling you something that they can't deliver on, at least the good ethical loan officers. And there's a lot of lousy ones out there, but there's also a lot of really great ones. So that's how mortgage rates and points work.